How will the new military conflict between Israel and Iran impact the market? Well, history suggests the effect may be much smaller than we'd expect. In the next couple of minutes, I'll break down what decades of data show us about how markets typically react to military conflicts and wars. And I'll also factor in what I've seen in my 28 years as a financial advisor. So as we know, on June 13th, Israel launched a strike on Iran's nuclear and military facilities, and Iran responded with drone and missile attacks. The impact on oil prices was significant on the day of the attack. Oil prices surged at a high point of 13%, and the S&P, however, dropped only about 1%. And by the end of the first day, oil prices had already started to come down, and the market's reaction was very mild. This is not unusual. Historically, when we look at military conflicts, we see temporary volatility in the market, maybe a temporary drop, but they rarely derail the market's long-term trajectory. Even with the escalation, the U.S. bombing of Iran's nuclear facilities, I still expect market reactions to remain muted after initial shocks. As geopolitical expert Ian Brenner has noted, markets tend to overreact in the short term and underreact in the long term. When there is a new military conflict or war, the market drops about 4.5%. In most cases, the market fully recovers in approximately 40 days on average. And 1 year later, markets are positive, or at least have been positive, 68% of the time, with average gains being around 8%. So wars are bad. We don't want them, but their impact on the markets tends to be muted and short term. Now with this conflict, there's another element, which is oil and oil supply, because it is always a concern when there's a war in the Middle East. But in this case, disruption to oil is very likely will be limited. Most of Iran's oil actually goes to China, not the US. And while we may worry that Iran could block the Strait of Hormuz, that would probably cause more problems. And it's not viewed as likely. It's not the 1970s today, and the US is much more energy independent. And the oil infrastructure of Iran has not been targeted. But I also think we could see that perhaps neither side appears eager for a long-term protracted conflict, hopefully. And we want to factor in what's going on in the US. Strong employment, steady GDP growth, and as I've been highlighting, falling inflation. So the market remains on solid ground. Wars are terrible. History has shown the effect of the stock market, though, is often very minor. If you're wondering how it fits into your portfolio or would like another opinion, I'm happy to talk.